now I want to go into the mortgage industry update. And I know, Daniel, you're going to have a lot of input on this. I put together a few charts and slides. So I would love to have your input on these, what you think about these reports that I put together. Now,
Happily.
I saw on CNBC, they were talking about the mortgage delinquency, the hardest hit states. They are Nevada, Hawaii, Michigan, New Jersey, and Rhode Island. In the sense that I was like, whew, thank God it's not California. So I thought it would be good to share this. But the unemployment, you saw Nevada, 25.3%, Hawaii, 22.6%, Michigan, 21.2%, New Jersey, 15.2%, and Rhode Island, 16.3%. So, the unemployment rate is definitely very tightly correlate with the mortgage delinquency, right? In California, I don't know if you have any numbers on California delinquency. Daniel, do you follow that?
I don't, but I have a opinion on it. If that helps, it's not solid numbers, but my opinion is, not even the whole state. Let's take the Bay Area and Los Angeles as examples, like the two biggest metropolitan areas in California. I don't think that the majority of people that were economically affected by being economically affected by the pandemic, and I say majority because there's always exceptions to the case, but I think the majority of people are people that actually are not in a financial position to be homeowners in the western part of California, essentially. So I have this because I have a lot of clients ask me that too. They say, well, I want to wait till October or November because everybody who's in forbearance, they're all going to lose their houses and I'm going to pick it up for a good deal. And I said, well, think about that really. Do you think the person that is owning a house now in the Bay Area or in Los Angeles, that, the majority of people that own houses in those areas are probably not, that have the type of jobs, that like retail job and restaurant work. And, of course you have in Los Angeles people in the entertainment industry that are being affected that maybe could be home buyers, but in the East Bay too, and the Bay Area in general, I find that most of the buyers are involved in work that primarily could be done from home, and they're not really economically impacted in the same way, where they may have a pay cut temporarily for 20 or 25%. They're not going to lose their house in the same sense that where in Nevada, somebody who makes $40,000 or $50,000 a year, they could own a 5-bedroom house in Nevada. I mean, I literally have a friend, he makes $50,000 a year. He owns a 5-bedroom, 3-bathroom house with a pool because it costs $180,000 in Las Vegas. So it's a different market. So I don't see that. I'd be curious what I think a lot of delinquencies in California, if there are any, and I don't know if they're counting forbearance as delinquencies or not, but if they are, I would feel that maybe a lot of people may have gone into forbearance as well, just to be precautionary or to take advantage of the fact that it's something they could do without being potentially penalized. And so, I don't have the statistics, but my guess would be that California would probably be a lot less, at least if you're considering the metropolitan areas.
Actually, I think I absolutely agree with you. So I sometimes, I work with a lot of investors as well, and they always ask, they're interested in investing in a lot of different areas. And when they ask me about like, oh, which market should I focus on? And I always talk about, you have to look at the employment in that area, right? I know a lot of people love Nevada. My only thing about Nevada is that it's so highly relying on one single industry, right? Casino and actual tourism as well. So it's like if that goes, pretty much the whole market is going to go down. And so there are a lot of different factors, but really the most important factors to look at is the employment in that area. And in terms of what you were saying about forbearance, as a matter of fact, I have some other slides I want to show, not necessarily about California, but definitely something about the forbearance. So here is a chart that's talk about like the mortgage delinquencies improved for the first time since January. So we've been having higher and higher mortgage delinquencies since January. And but then the serious delinquencies, meaning like 90 days plus, has surged to 9-year high, which is from our last recession. Now let's look at the numbers here. Is that the total U.S. loan delinquency rate here has gone basically, as I think it was 7.8 and then came down to 7.59. But then compared to last year, it has gone up 103.55%, and it is quite a bit. And this is like talking about over 30 days delinquency. That's like over 2 million houses. Just like what you were saying, they are offering these forbearance currently. So I know personally, I know people who actually took advantage of that, not because they cannot afford it, just because they want to be careful. It's like, might as well do it, right? Because they are offering that. Of course, that doesn't apply to every single person, but I'm just saying, like, partially, some people took the forbearances because they feel like they can, why not, just take advantage of that for now. Now, so will this whole mortgage delinquencies really leading to the foreclosures? That's the biggest question, right? Because our last recession was really due to, there were so many foreclosures. For my business, 2008 to 2011, or maybe even 2012, literally, I think 80 to 90% of the business was in short sales or foreclosures, like REOs business. That's it. You rarely have like regular sales at the time. But now, what will happen? If they have delinquency, are they really going to go into foreclosures? So this is really interesting. Is by Black Knight, and they show that over 77% of these forbearance actually have at least 20% equity in their home. So that, which means that they can just sell their home instead of going through the foreclosures or going through the short sales or being foreclosed on. So this is something quite interesting to see, that if last recession, it was mainly because there was no equity in it. So that's why everybody was doing short sales and foreclosure. So I definitely, that's why I absolutely agree with you, Daniel, that I think the forbearance is just, some people are taking advantage of it right now, but is it going to lead to massive foreclosures? I really don't feel that will happen, especially in the Bay Area and LA area.
So I was going to agree with that too, is that if it happens, it's not going to be in the Bay Area or LA. I certainly could see that happening maybe in a market like Las Vegas, especially if the casinos close back down again, because right now they may have 20% equity, but if the housing market in that small area starts crashing, then maybe they don't have equity anymore. And they're out of work, and they may end up in a situation where they have foreclosures there. But I don't see it in Los Angeles and the Bay Area. It's a very different, what we're going through now is very different than what we went through in 2008. It's not the same thing. 2008 was caused by bad lending, essentially, and everybody was able to buy a house without having to prove what their income was. They could get 100% financing back then. It was a disaster waiting to be made, whereas this is a very different thing. This is people, there is a great number of people in this country that are hurting right now because they're not able to work, or not they've lost their jobs. But it's a different situation in the sense that it's not a housing bubble that's popped that was created artificially. This has to do with actually just a pandemic that's having hopefully a temporary impact on the economy, not a long-term impact. Only time will tell. But again, I try to look at it from our markets, like the Bay Area, Los Angeles, these markets. And I feel like they're almost, not completely, but almost immune to what's going on, because the majority of people that can afford homeownership in those areas are typically not in fields of work that are, let's say 80 to 90% of the people are not in lines of work that are being heavily enough affected by the pandemic that they're not able to make their payments, and that they would potentially have to lose their house. And furthermore, as you mentioned, because people do have equity, and in the markets where we just looked at some numbers, the housing prices are still going up, at least with single family, we saw that in the numbers that you showed. In a market where they're still going up, there's no reason to foreclose. If worst case scenario, they sell it and cash the equity they have. But, I think there's a lot of people, I hear it from clients all the time that, I'm going to wait for this big foreclosure and I'm going to buy a house for 50 cents on the dollar. And by the time you think that comes, it'll actually cost you $1.50 to buy the same house. So, it's a way that you can't win. The longer you wait in California, the more expensive a house is. Almost always speaking historically. You know, it's you can't wait for opportunity. The opportunity is now when interest rates are, when they're giving away money. That's the bet. This is like the most opportune time, in my opinion.
And yeah, and I always say, unless you're a flipper, yes, I do agree that you should be
Yeah.
very careful right now. It is risky
Yes.
to flip homes. But if you're buying for yourself for long term, it is, you know, this is the time where you need to take advantage of the low interest rate, because once it goes up, I don't know if it will come back down. This is historic low. When I first started investing, I was buying at 7% or 7.25% mortgage rates at the time. Now is at, you know, below 3. I'm like, my gosh, we got to take advantage of that.
Absolutely.
And let's see, this is the mortgage rate charts here. As you see, again, 30 years have come down quite a bit. And this is the 15 years. And maybe, Daniel, you can definitely give me a little bit more information about this. But even 30 years, it says like has gone down to a record low right now. I just kind of pulled this rates from Wells Fargo. This actually has not changed since last webinar. It's still at 3.25 for 30 years fixed jumbo. I know you cannot just call it, okay, 3.25, everybody gets that. Of course, depends on your credit score, depends on your loan to value, it depends on a lot of different factors. So maybe this is a good time to ask you, Daniel, what are the most important things that people need to pay attention to before they ask for a rate quote?
Yeah, well, I mean, it's just important to understand that, you know, what you see in the media, when the media says, hey, and I see a ton of articles that say, you know, the 30-year rate is now at 2.998% or something like that. You know, it's important to know that any of these numbers are based on, usually they're based on a couple scenarios. One is they're based on the base conforming nationwide loan limit, which is $510,400 loan amount nationwide. They're typically based on a 25% down payment because there's better pricing at 25% versus 20. And furthermore, a lot of times that rate may include points. So additional fees you have to pay a bank to get a lower rate. But as an example right now, many clients that I'm working with, depending on their exact scenario, of course, there's a big variance. Every scenario is different. So just know that you can't just blanket and say, what is my rate? That's like saying, how much does a car cost? It could be for $20, or it could be a Maybach for $200,000. So, you know, it's an arbitrary question. So you have to be very detailed about it. So when you're talking to lenders, it's important to specify your exact scenario. What is your credit score? What purchase price are you looking to buy at? What down payment are you looking at? And what type of property is it? Whether it be a condo or townhome, family or multi-unit, all of those are going to have different rates. So it's important to be very specific with your lender as to, if you're just trying to get quotes on rates, to be very specific about the scenario, and ask the lender too if there's any points associated with the rates that they quote. Because what I find is a lot of lenders, what they try to do to entice somebody to come to them is they quote the lowest rate they possibly can without mentioning, since it's just a verbal quote, they won't mention the costs associated with that rate just to get somebody interested in working with them. So if you're really trying to, you know, shop and get a comparison, know what what are the costs associated with the rate, and make sure the rate is based on an actual scenario you're looking for. But these days I'm seeing, you know, for example, today I spoke with someone that was looking to buy an $800,000 single family home with 25% down payment, and he had good credit, everything was in great shape, and we quoted 2.75% 30-year fixed with half a point. I mean, it's and 2% with 0 points. So the right scenarios, there's some amazing options out there. You know, I'm finding that, really honestly, I always tell everybody the same thing. I've been doing this 15 plus years, but if I had done this 150 years, I would say the same thing. Rates have never been better than they are right now. And you know, to your point, as a flipper too, right? It's, yes, now is a little bit of a risky time for a flipper because there's still some unknown future. Somebody are trying to buy a house for them to live in or to hold long term. Even as an investor, as a long term hold, I honestly think it's a phenomenal time because you can have such cheap money to borrow that you can wait out the market. Even if in 2-3 years from now the prices do come down a little bit, historically speaking, over a 10-year period, there's never been in the history, recorded history, at least that I'm aware of, any time that over a 10-year span, housing prices in Los Angeles or the Bay Area have ended up less than where they were 10 years prior, which is tells me that as long as you're willing to hold long term, I don't think you can go wrong as far as making money in appreciation of your property in these particular markets. It's very, very specific. I have somebody I know in Maryland and bought in 2007. We're now 13 years later, they still haven't recovered from the value drop that they had. So, it's very specific that we are in a unique market where appreciation truly never seems to end. Although there's dips here and there, it really, in a 10-year run, nobody has failed at this yet.
Absolutely. And, from our experience as a realtor, I mean, we always kind of recommend a few loan officers that we've worked with. We know they're honest. We know that they do a very good job, like, giving us updates all the time. But sometimes our clients do say like, hey, I saw, just like what you were saying, I saw an ad, they're quoting 2.75%. As a matter of fact, we just had somebody who said that. It's like this online, I don't want to name names, but this online loan program said that she can get 2.75 or 2.65, I forgot, 30 years fixed. And then, of course, she insisted going with them. And then during escrow, they said, nope, sorry, you don't qualify for that 2.75%. You qualify for this higher ones. So now she's stuck because you're under contract. You have this timeline you have to fulfill. You don't have time to shop around anymore. So it is really important. And on top of that, this online platform, whoever that person, loan officers, never give us any updates. So we never know like what's going on. Our client couldn't even find or get in touch with them. They will contact you when they have updates. That's about it. They're not going to talk to you in between the time frame. So you have to be very careful. Trust. We always say, find somebody you can trust. You can trust. Find the reviews, and your realtors have worked with these loan officers. They are the one who will tell you the truth and also do a good job. But don't just randomly find an online lending program out there. I mean, if you're a refi, you are not under some time crunch, maybe you can test it out, I guess. But if you're doing purchase, just be very careful who you're choosing in terms of financing. Now, I want to also share with everybody, this is also a chart that I shared last time regarding the mortgage rates projections by a few of these agencies and organizations. And pretty much everybody has this prediction that the interest rate is going to stay really low for the next 4 quarters until 2021. Is that what you're seeing, Daniel, as well?
Yeah, I've been reading the same thing, and a lot of people ask me about this. And my general opinion is I don't see any reason why they should go up. I think they should stay down. The economy is still not in a great place, and I think it would be detrimental to the economy to change the direction of the interest rates. I do think that one X factor, which I don't really have an opinion how it's going to affect things, but is that we are in an election year, and I don't know what implications that will have on interest rates, because I feel like interest rates do kind of follow consumer confidence. So I don't know what's going to happen with rates as a result of the election, but I will say that my expectation is that I do agree with these analyses. I think interest rates should stay at these historic lows, bottom of the 3s, top of the 2s, kind of in that range for 30-year fixed for the next 18 months is what I would agree with as well.
Mm-hmm. Yeah, and we always say that housing is really a lead indicator to bring the economy back. And because right now, to be honest with you, all these small businesses are not doing so well. These cities or the federal government, they really need, I should more say like the city, on the city level and the county level, they really need property tax and county transfer tax. If you don't have housing transactions, you don't really have these taxes. And they learned from last 2008 mortgage crisis, they don't want to repeat that again. So that's why this time they have reacted so fast to drop the federal rate, and now the mortgage rate, of course, has been staying low as well. Thank you so much for watching our YouTube channel, and don't forget to subscribe to our channel, like our videos, make some comments, because we're going to keep you posted on the most updated real estate news, housing market data, and also real estate tips and advice from all over the real estate industry. So thank you so much for watching, and I'll see you next time.